Hi, everyone, and thank you for joining us for today's webinar, FASB Financial Statement Update, the Impact on Nonprofit and Private Education Reporting. Just a note, if you're attending the webinar to receive CE, and if you meet the requirements, which I'll go over in a moment, you will receive an email within 3 business days with access to your certificate of completion. In addition, we will be sending out a copy of the PowerPoint and a recording of today's session for reference later on. Now just a quick review of some housekeeping items. You can maximize or minimize the webinar pane during the presentation by using the red arrow buttons. In the webinar pane, you'll see a chat box. We also encourage you to ask questions. Just type your question in and click submit. If we have time, we'll answer those questions during the webinar or we'll answer them toward the end. Second, to ensure good audio quality, please check your settings. If you're using a telephone, please click on the Use Telephone Audio mode. If you're listening through your computer, then please click on the Use Mic and Speakers option. Now a quick review of the California CE requirements. To qualify for California CE, you must do the following. Use a personal computer, no PDAs, and log in with your own information and unique URL. You must be logged into our online software for at least 50 consecutive minutes within the scheduled time frame of the webinar. You must actively respond to at least 75% of the polling questions. There are 4, which means you need to answer 3, and you must complete the evaluation survey at the end of the webinar. And now a quick review of our presenters. Dean, who's going to be moderating today's webinar, he's helped numerous private schools, social service organizations, performing and fine arts, faith-based orgs address their tax, audit, and outsourced accounting needs. Boards, finance, and audit committees have grasped his laser focus on bringing to life the audit items that matter most to them. Next up, we have Stacy Kowalczyk. She's an audit senior manager with our firm. She has more than 13 years of experience providing audits, reviews, and other attest services to nonprofits in the social service, education, higher education, healthcare, and religious space. She works with clients in a trust advisory capacity, keeping them informed in a way that is easy to understand and not overwhelming. And finally, we have Matt Gard, who's also an audit senior manager with the firm. He has more than 10 years of experience serving nonprofit and private education clients, including the Fine Arts Museum of San Francisco, the San Francisco Opera, Harvard Westlake, De La Salle, and other institutions. Quickly, to go over our learning objectives for CE, today we're going to identify the several proposed FASB nonprofit financial statement changes, describe how the new rules may affect your particular organization, be it your social service, faith-based, fine arts, education, and beyond. And then we're going to talk about ways to effectively present that information to key stakeholders, including your board and others. And with that, I'll turn it over to Dean.
Thank you, Debbie. Thank you, everyone, for tuning in this morning. I'm very glad that I am the moderator today because we are going to cover a lot of technical and a lot of important information. A lot of that you'll see on the screen right now. We'll walk through the current status of the exposure draft for all of these different areas. And these ones too. As you can see, there's a lot of information, and we'll go ahead and get started. First off with the redeliberation plan. Stacy, I know that the FASB met in October after the comment period on the exposure draft that was issued in April, and I heard that the board had not yet determined the timing of the release of that final update. However, we do know that the board basically made a decision to divide its deliberations of the proposed update into 2 work streams. One that's more, what's the word here, shorter term, and one that's more longer term. Can you give us some information or breakdown on the 2 work streams?
Yeah, Dean, that's correct. So when we first told you about the key provisions of the exposure draft in our webinar last year in April, right after the exposure draft came out, we talked to you about these key 5 financial reporting areas that would be affected. So that's the net asset classifications, the measure of operations, reporting of expenses, some changes to the cash flow statement, and changes surrounding disclosure of liquidity. So if we look at the way that these 5 items are now divided up into the FASB's redeliberation plan, the first phase there is areas that are not dependent upon other projects and are improvements to the nonprofit financial reporting that the FASB may realize in the near term, as Dean mentioned. So phase 1 is going to include the net asset classification scheme and related issues. It's going to include disclosure and presentation of expenses, disclosure surrounding presentation of an operating measure, and the liquidity information. Phase 2 is going to be longer term, as Dean mentioned. It's going to be reconsideration of proposed changes that are likely to require more time just because of all the stakeholder feedback and other concerns that were addressed. Also, these two items could dovetail on other projects that the FASB is working on. And so that includes the presentation of the operating measure on the financial statements, specifically the piece that's not addressed through the disclosure requirements in phase 1, and then the corresponding realignment of certain information in the statement of cash flows as a result of that operating measure.
Oh, there you go. Statement of cash flows. I heard it. You know, when we talk to nonprofit board members and constituents, cash flows is always a big deal. And I think that the proposed change with regards to cash flows is also going to be a big deal. So Stacy and Matt, I'd love to kind of hear your thoughts on what's going to be happening with cash flows. But before we do want to hear from the audience on how many of you and your boards would prefer a direct or indirect method to presenting cash flow information. You know, I will say from my own perspective, I don't think I've prepared a direct method of cash flows since intermediate accounting 2. Is that a fair statement, Stacey?
Yeah, I think that I'm in the same boat as you.
So as Dean mentioned, just a quick reminder that if you're here for CE, this is one of the 4 polling questions. You need to make sure you answer 3. So if you're not paying attention, pay attention now, quickly answer the question, which method of cash flow presentation do you prefer? Direct, indirect, or not sure? And we'll close the poll here in 3, 2, and 1.
Okay, and look at that. Of course, what we know, we're all accountants on the line here, and we're all very comfortable with what we have historically done, which is for most everyone the indirect method of cash flows. But we do have a little bit, that 20% that prefer the direct, and a little bit that are not sure. So we'll kind of walk through what these changes might look like for everyone.
Yeah, so the FASB's verdict here, if you will, if you recall from the exposure draft, the exposure draft said that nonprofits would be required to present the direct method. And so now the verdict is that nonprofits are allowed to use either the direct or the indirect method of presenting operating cash flows. If a nonprofit does choose to present the direct method, that indirect reconciliation, which is another component of the cash flow statement, would not be required if the nonprofit chose to go that route. And I guess, you know, kind of overall here, I have some mixed thoughts about the FASB's decisions here. I think that, you know, on one hand, the direct method is more transparent to users of the financials who may not understand an indirect method reconciliation. When I was thinking about some of the points here that my clients have been talking about lately, I thought that it would be really interesting to summarize some of the cons of the indirect method and contrast those with the pros of the direct method. So on this slide here, some of the cons of the indirect method is that, as we mentioned, that principal disadvantage is that it does not report actual operating cash inflows and outflows. So those would be the inflows from donors, outflows to vendors, and outflows to pay payroll expenses, for example. Those would be some of the biggest categories. It's less informative. It's criticized basically also for just repeating information in the statement of activities and financial position, and for somebody to understand it would have to sort of take a deeper dive into it on their own. It also cannot be effortlessly transformed into a direct method presentation. So if I contrast with the advantages of presenting the direct method, you know, again, as we mentioned, that direct method is more informative, more transparent. It better represents the organization's cash cycle as well, which is impactful to creditors and donors and other users. That'll also, I think, be a key topic of conversation when we talk about liquidity disclosures as well. It's helpful in cash flow variance analysis and can be effortlessly transformed into the indirect method presentation.
So real quick, just to kind of wrap that slide up, I mean, we get the choice.
Right, we have the choice.
Yeah, yeah, Dan. When this the exposure draft first came out, my clients were asking me, why is the direct method required? And they had, a lot of concerns with it. One, because they didn't know how to do the direct method, and two, they say, my board members or my finance committee members, they're all for-profit people that understand the for-profit statement. And in the for-profit world, they're not required to do direct method. So why would it be different in the not-for-profit world? So, with the amendment here to what they had originally proposed and maintaining that flexibility, I think that was a good decision.
Yeah, and I think, from reading through some of the comment letters also from the exposure draft, I think that, organizations, auditee organizations and auditors alike just, they feel that the time and the cost involved to prepare the direct method doesn't equate to the value on the other side of it. I think that's the simple.
Sure. Well, then that makes sense, Stacy. So I guess that we'll probably continue to see a lot of indirect method statement of cash flows, more than likely.
Yeah, I would agree.
Okay, good. All right, net asset classification and related disclosures. And I must say to everyone on the line, I'm learning this is just as much as you are. I'm glad to be here with our technical experts, Stacy and Matt. When I heard about this one, I said, okay, well, this one seems like a game changer. It seems like the FASB is really trying to address concerns and trying to, take away some of the complexity with regards to the three net asset classes. So let's kind of talk about what some of these changes might look like.
Yeah, so Dean, you're absolutely right again. I mean, the current required distinction between the permanent and temporary restrictions has been blurred, as we reported to you last year, by changes in state laws, for example, like MIFA laws that diminish the relevance and sort of rendered that distinction less useful on the face of the statements to users. So reducing that number of classes of net assets that would be required to be reported can reduce complexity, enhances the understandability, and just creates overall better use of a multi-period or comparative presentation on the financial statements. I think, when I look back at the exposure draft, it seems like the main theme here in this net asset classification schemata is just providing transparency, getting more utility, getting more understandability, and more collaboration and consistency across the different sub-niches in the nonprofit industry.
Well, yeah, absolutely. Who doesn't want more transparency? It seems like that's just the world that we're living in today. So Stacy and Matt, what are some of the common concerns that your clients are raising when you talk about this kind of net asset classification change?
Yeah, Dean, across the board, whenever there's any change, clients want to know, well, how does that affect what I'm currently doing? How am I currently reporting? And what's our current chart of accounts look like? And what we're telling our clients is this really won't change what you're doing internally. You're already tracking unrestricted, temp restricted, and perm restricted net assets, which I think you still will want to do. But what all you're going to do here is roll up the permanently and temporary restricted net assets into net assets with donor restrictions on the financial statement. So going back to your question, I think clients will want to keep reporting the same way they always have. It's just you're going to roll it up a little different in the financial statements.
So don't change your chart of account structure.
Yeah, no, that's good to know. What about your clients, Stacy? Any concerns there?
Yeah, I think my clients have, some of the same comments as Matt just mentioned. I think the other thing that they addressed is like, well, this is great that we've got this transparency on the face of the statements, but how do we still get across the point, about when those resources and how they can be used? I think that's the main question that comes from what I've heard.
Okay, sounds good. So maybe we can kind of see an example up, and here it is up on the screen of what this looks like in real life.
Yeah, so this is a simple example of a statement of financial position for a social service, community-based nonprofit organization. We'll show you a statement of activities here in a second. But, you can see the net asset section down at the bottom there is collapsed into those net asset categories with and without donor restrictions. You can see there that the categories also reference a footnote disclosure. So for some organizations, that might be useful just to point out and point the reader or the user directly to the footnote that's going to describe some more detail about those net asset classifications.
You know, and I gotta say that this looks pretty easy to understand. I mean, without donor restriction, with donor restriction, no more having to explain what a temporarily restricted net asset is or a contribution. Do you guys agree with that?
Yeah, I think it's much more straightforward. Yeah, like you said, it either has donor restrictions or it doesn't, and you see that here on the statement of financial position.
That's good. That's good. The other thing that I'm seeing here is that I'm seeing changes retroactive. Is that fair to say?
Yeah, when we talk about the transition method that's that the FASB's talked through, it is going to be a retroactive application. So you'll have to, if you're presenting 2 years worth of information on your financials, you're going to have to go back and make these changes as of the earliest period presented. So if we look at the statement of activities, let's just go to that real quick. To address stakeholder concern about some of the condensing of the restricted classes of the net assets, just kind of zero in there on the middle piece of that presentation of the statements of the net assets released from restriction. You know, again, most of us here, especially for community-based, and I think with, you know, education, both private and higher ed and arts organizations, et cetera, we're used to just seeing this one line item of net assets released from restriction. But here you can see there's an added layer of detail that shows why those restrictions are being released from restriction. So either satisfying programmatic aspects, satisfaction of equipment acquisitions with releases, endowment related, time related. Those are things, you know, and kind of getting back to that transparency theme, those are presentation, not only on the face of the statements, but in the notes that, you know, we're going to get used to seeing as more common to describe further these restrictions. And that addresses some of the concern about the going from the temporary and permanently restricted to just a collapsed column.
So Stacy, I mean, that jumps off the page to me to see the detail, not just the one line item with regards to releases. Is that a requirement?
So right now it's not. Right now in the footnote disclosures, it is required to show detail about the temporarily restricted net assets by restriction. But a lot of times you don't see a lot. You'll just, you know, see by the program name, or you'll see by like donor named funds or something like that. I have some arts organizations that will present that information. But this is actually sort of taking it one further and saying, hey, this is what these resources are available for in more detail, and this is how and when they're going to get utilized.
Great.
The other thing that, you know, we mentioned a couple of times already is that the presentation is also going to facilitate that multi-year, that multi-comparative period presentation. So here you can see, I guess I should have had an example of a multi-period presentation with the classifications currently required. But I think, you know, when looking at this, I think this is a lot cleaner. It's really easy to compare, you know, across the years where the activity is happening, where the releases are happening. It's just an overall, I believe, cleaner presentation. Again, it looks like in reviewing the comment letters that, you know, a lot of the constituent organizations and auditors out there feel the same way as well.
Well, you know, we always know that what happens on the face of the financial statements is always backed up with a hefty disclosure requirement. Is that fair to say?
That is fair to say.
All right. So tell me what kind of disclosure requirement changes we can be looking forward to.
Yeah, so key there is the first bullet point, the nature and the amount of the donor restrictions. So either on the face of the statement or in the notes. Additionally, underwater endowments, which are going to be a key part of that classification of those net assets with donor restrictions, there's some key disclosures that are going to be very, very imperative to the financials. So one is the nonprofit's policy to either reduce expenditure or not spend from those funds, the aggregate fair value of those funds, and then the aggregate original endowment gift amount, or the level that the donor or law has required to be maintained in perpetuity. And sort of, from those two bullets, the next disclosure is the aggregate amount of deficiencies in those endowments. Again, some of that information is not new to us. Nonprofits, by and large, because of the current disclosure requirements, are already reporting much of this information, but there will be a little bit more detail to report these bullets by the individual endowments. And then, of course, the governance policy regarding spending is a key disclosure requirement.
Yeah, Stacy, I think one of the key changes here, and I've had a lot of conversations with my clients about, is underwater endowments. Previously, you would see that show up in the unrestricted portion of your endowment footnote. And a lot of my clients would ask, how does that make sense? Why is this unrestricted type amount? So this kind of fixes that and puts them into the net assets with donor restrictions if you do have an underwater endowment.
That's good. That's good. Matt and I just met with a nonprofit the other day that said that they had recently got 98% of their very large endowment within the past couple years, and unfortunately put that all in the stock market at about its peak, and now have some underwater situations to deal with. So that's pretty good for organizations like that.
So let's just take a look at this in a little bit of a tabular format, just a little bit of what we just mentioned. That first screenshot there are those net assets that are subject to expenditure for specific purposes. So again, as I mentioned, this disclosure probably doesn't look a lot different from what you're used to seeing, except that one enhancement is the nature of the purposes for the expenditure restrictions are broken down a little bit further within the programs. The disclosure also separates out further those net assets that are just subject to the passage of time. That second screenshot there on the bottom in the green box is also an example of the proposed disclosures for the nature and amount of donor restrictions related to investments that are held in perpetuity by program that are available to support those specific program activities that are shown.
And, it seems like that second piece there would be pretty important for nonprofits with significant endowments. Matt, how do you see this working out with some of your clients?
Yeah, I think a lot of clients already may break out this level of detail, but as you'll see with a number of the different topics we're discussing, it all comes back to transparency and providing more detail. So this just provides more detail as to what your endowment is comprised of, what it's to be used for, and the different programs that it goes to support.
Yeah, so next slide here is just the spending policy and the investment objectives related to spending policy. That was a key point on the disclosure of those net assets with restrictions. Here you can see a little bit of what we mentioned regarding the disclosure requirements for a nonprofit's plan to either reduce or delay expenditures. You can also see that the nonprofit in this example concluded that it would only draw a certain amount from underwater endowment funds instead of that normal 5% that it typically draws. Please keep in mind that these changes, you should still consider specific donor intent, relevant laws, regulations, and determining spending policies and so on and so forth. This is a really, I think, key disclosure where, auditors and auditee entities can discuss through this and just make sure, again, that it's transparent, meets the requirements, tells the story about the organization's endowments and spending policy.
Well, that sounds good. What about, so I've heard a lot about the net asset restrictions from donors category. What about the net asset category without donor restrictions? I know right now we do board designated endowment type of disclosures. Is there going to be any other type of disclosures for board designated items?
Yeah, and so this is a great segue. There was actually just a question that came in wanting to know if there was going to be change in presentation on the board designated funds. So, right now in nonprofit financial statements, we just see, a line item on the face of the statements, or maybe just a couple sentences in the footnote saying, hey, we have these board designated net assets, and typically it centers around the board designated endowments. But with the exposure draft, the FASB really intends here to, again, address transparency. And they would be required, nonprofits would be required to disclose governing board designations, appropriations, and other transfers that result in the addition or removal of self-imposed limits on those resources. So those disclosures would include a description of the purpose, amount, types of transfer, and an example, for example, because of a longstanding board decision, one-time policy, one-time decision-making, other reasons for the purpose and types of the transfers. This is also going to get into a little bit later on the discussion of the operating measure that Matt will go over a little bit later, where the transfer presentation on the face of the financial statements is really going to center around some of these board imposed or internal imposed designations.
And that brings us to our second polling question. So again, reminder for those looking for CE, this is the second question. If you missed the first one, make sure you answer this because you'll need to answer 3. Just a statement, true, false. The proposed net asset classification and disclosure changes will provide additional transparency. Is that true? A, B, false, or C, you're not sure? And for those of you asking, yes, we will be sending around a recording and the PDF of the slide presentation after the webinar. So you'll see an email from me within the next couple of days, sending that out to you all to review.
Great. So far, we're at about 83% voted, and we want you to all get your CPE, especially for any of you May or June birthdays out there, like myself, that need to do a lot of CPE. So here we go. We're at 88%, and we're about to close it off pretty soon.
Yep, we'll close the polls in 3, 2, and 1. It looks like basically everybody said true. They must have been listening.
That's good. That's good. Yes. Transparency seems like a reoccurring theme in all that is going on. All right. Our next section, information useful in assessing liquidity. To me, this is one of the hottest topics in nonprofit. Every board member that I talk to, they want to know about liquidity. They want to know about cash and reserves and operating reserves and kind of all of that. So, I think that the FASB, and I think Stacy and Matt are going to cover this, but they're trying to add, again, keyword here, transparency with regards to liquidity. We know that there's been some times in the past where users have thought that part of these net assets is without contractual, legal, or any other type of restriction. And as a result, creditors, donors, or other users could reach the wrong conclusion about an entity's financial position, particularly its financial flexibility and liquidity. Matt and Stacy, what are you guys seeing with your clients?
Yeah, Dean, kind of what you've talked about, liquidity is a hot topic we hear about all the time. And I think what the FASB's trying to address with this part on liquidity is that, not-for-profits manage their liquidity differently from one to the next. And what they're trying to present here for the users of the financial statements is show exactly how the not-for-profit you're looking at manages liquidity, and gives a picture of the overall liquidity of the organization, whereas it can at times be difficult to determine that based on the face of the financials themselves.
Yeah, so if we look at, if we just look at the next slide and kind of take a look into how nonprofits should define liquidity time horizon and what they should disclose. I mean, nonprofits are required to look out, on that horizon of when they're going to have cash needs to meet 30, 60, 90-day obligations. And that's, just with general vendors and obligations of the organization, but also it could be related to any type of capital commitments too. That nonprofit's also going to have to disclose financial assets that are going to be able to satisfy those liquidity requirements. In addition to other qualitative information about how the nonprofit manages its liquidity. So that could include strategies for assessing entity-wide risks, including the use of credit lines, again, establishing liquidity reserves and determining that time horizon. I think, Dean made a great point about how users of nonprofit financial statements can draw conclusions. Matt also made that same point. one of the things that, I've heard from my clients in the higher ed and in the social service space, and even in reviewing the comment letters from the exposure draft, is that there's concern that once that timeline to liquidity is defined, that nonprofits will want to change it based on their certain situations or certain circumstances at a specific point in time. Additionally, the self-defined liquidity window, so if that's 90 days, by the time an organization completes its audited financial statement, so if we look at a higher ed or a private education nonprofit organization, that could already be dated, by the time the financial statements are issued. And so it may diminish the relevance. So there's a little bit, kind of more that's going to go into, discussing what liquidity means for an organization and that timeline. So again, this is a really key area that we think we should, organizations should talk to their auditors about.
Is there anything that you think about, Matt, for a private school in particular?
Yeah, I think just, in particular, time horizon for not-for-profits are going to be different from one organization to another. Some it may only be 30 days, some it may be 90 days or even longer. Like you mentioned, private schools, sometimes schools receive large influx of cash at or near year end. It looks like they have, a ton of cash on hand, but they have to manage that cash throughout the year. So there's just different time horizons for the different organizations. Like Stacy mentioned, this is going to be an area that's new for everyone, and recommend discussing it with your auditor as soon as this is effective, and as soon as you have to start looking at it, just to make sure that the wording makes sense for your organization and shows the organization in the right light.
So the next two slides that we have are just disclosure examples. So one is in a narrative format and the other one is in a tabular format. Either presentation would be fine in the financial statements, but you can see in both of these slides that the nonprofit is disclosing some of those elements that we just discussed. And it's saying in its notes to the financials that, hey, we have these certain restrictions because they're either donor imposed or contractual. And so these assets and these resources are not going to be available to satisfy liquidity. And both note disclosures also discuss a little bit more around that time horizon. So first slide is a narrative, second slide is a tabular format. Either one is fine for a nonprofit organization to use.
Okay. All right, so this section, if you're a nonprofit out there that has a large endowment or even significant investments on your statement of financial position, this is an area that you definitely want to tune into. So let's talk about investment return.
Yeah, like Dean mentioned, if you have investments, there's going to be a little bit of change as far as any expenses related to managing those investments, how those are going to be presented. I think previously there's a lot of diversity in where organizations put those expenses. And so the FASB is trying to address and make it consistent here by requiring to present the investment return net of any external or direct internal investment expenses on the statement of activities. So you're permitted, but you're no longer required to disclose any of the investment expenses that are netted against that investment return. So I think this helps provide more comparable measure across all not-for-profits, regardless of if they're externally managed, internally managed, whether they're in different types of investments. You're really just going to see one number as far as investment return and be able to kind of see how that compares amongst different not-for-profits. Also, the disclosure of investment income components in the endowment roll forward is no longer required, so you don't have to break out the investment income, the realized gains, unrealized gains in that endowment roll forward any longer. And then lastly, since you're now netting investment expenses against the income, you're no longer required to include that as part of the functional expense analysis, which we'll walk through some of the changes there coming up.
Thanks, Matt. And that brings us to our third polling question. How does your organization currently present its expenses? And Matt, actually, maybe you should read these because I kind of condensed your language. So
Sure. So A is by natural class on the statement of activities and then by function in the footnotes. B is by natural class on the statement of activities with no disclosure in the footnotes. C is by function on the statement of activities. D is on the statement of activities and then having a separate functional expense supplemental schedule. And E is not sure.
perfect. So get those answers in. Again, for CE, this is our third question, so make sure you answer. We'll get those answers in. We'll close the polls here in 3, 2, and 1. And it looks like most people said on the statement of activities and in the functional expenses schedule.
Thanks, Debbie. So I'm actually a little bit surprised on that one because I guess most of the clients I work with, we don't necessarily have a separate functional expense schedule, but at any rate, you can see there's a lot of diversity here. Organizations are reporting their expenses differently. So what the FASB is trying to address here is they want the financial statements, not-for-profits, to now disclose their expenses both by function and by natural class. And by function, I mean amongst program and supporting services, so your G&A and your fundraising. And as far as natural classification, that would be your salaries and benefits, your occupancy expenses, depreciation. Well, now the not-for-profits are going to be required to present both of them. And the key is that they will both be in one place. So whereas, in the polling question, some were presenting it one way on the statement of activities, one way in the footnotes. Well, now you will be required to present them both in one place. So yeah, I already covered most of this. Can you go to the next one? So as far as an example of how you could do that, here's an example of that. So you have your natural class going down the page, your salaries and benefits, occupancy, depreciation, and then you have it going over the program activities, supporting activities. And so it's broken out by both natural and functional class here on the financial statements. The last thing I wanted to add here is, so like you see depreciation, and depreciation is allocated between the program activities and supporting activities, both G&A and fundraising. So that's a good segue into my next topic, which are there are going to be some enhanced disclosures about those allocations, as well as some improved guidance on what constitutes management and general activities.
Well, I'm glad to hear that, Matt. I mean, this is another area where I think there's been a lot of uncertainty or a lot of quote unquote estimate out there, and people would like some more guidance and some more, direction on this exact topic.
Yeah, I think, I have a few nonprofits actually, if I thought back to that previous slide there on the disclosure example Matt went over, I've got a couple of nonprofits that are social service organizations that are already, disclosing that type of information. They sort of already have this, down pat. And, I know that it's received a lot of, good comments from boards and other users just about, again, transparency makes it easier.
Yeah, so now required will be, the methodology using to allocate costs by function. So, typically most of the organizations I work with, any of their facility costs, depreciation are typically allocated by a square footage methodology. Some may use a consumption methodology based on what functions consume the most of those expenses. Salaries may be allocated by time spent in each function. Well, now in the footnotes, you'll be required to disclose what methodology you're using. So that'll provide some more clarity on and comparability as to what organizations are using to allocate their costs. Then the second point that Dean kind of alluded to is, there's a lot of confusion as to what types of expenses fall into each function. And so the FASB will be providing some implementation guidance to better depict the types of costs that can be allocated amongst program and supporting services. So hopefully with this update, it'll provide some more clarity to not-for-profit organizations on what expenses they should be considering and what they should be considering allocating amongst the different functions.
Yeah, Matt, I think you addressed, there was a question that came in about the disclosures being something more about the allocation than just management's estimate, right? I know you probably see the same thing. We see that a lot, and it's not really descriptive. So yeah, that's huge.
So it sounds like one level deeper, Stacy. Not just saying, yeah, we did management's best estimate, but saying we did do management's best estimate and we used an industry standard of square footage allocation.
Mm-hmm.
Or whatever, they want to use.
Absolutely.
Okay.
Okay, so then the last topic that we're going to discuss relates to the operating measure. And I know when the exposure draft first came out, this was kind of the hot topic that my clients wanted to discuss because it's kind of one of the more interesting changes. It's also the one with probably more controversy or potential issues that could result from it. And so, as you'll see on the next slide, what the FASB has done is they're going to be, as part of Stacy had talked about at the beginning, moving into two different phases. Well, the majority of this operating measure part of the exposure draft is getting deferred to phase 2 because of the issues. Some of the we've read many of the comment letters, and many organizations are finding it tough to figure out exactly what their operation measure is. I think the exposure draft kind of alluded to two items: mission and availability. So, if it directly affects your mission, that's probably should be part of your operating measures. If it's available for current period, it should be part of your operating measures. So I tried to clarify what that should be, but I think a lot of organizations are having issues as to figuring that out, or really the amount of work that would take to figure that out and change their financial statements. So the part related to this that is going to be effective as part of the phase 1 of the project is it really just enhances the reporting for those that already present a self-defined operating measure. So, the standards currently provide flexibility to not-for-profits to develop an operating measure that makes sense for their organization. So any of you organizations out there that are already presenting kind of this operating measure in your financials, where you have your income and expenses from operations, and then you have your non-operating section. Well, any of those organizations that are already doing that, you'll just be required, and you have transfers or board designations or appropriations that impact that operating measure. So, things are transferred from non-operating into operating. If you have those transfers with this change to phase one, you're just required to put more information, going back to the transparency and just further detail. So when we look at the next slide, we'll kind of see what an example of that, right? So at the very top, if you have an operating measure, you have your operating excess before transfers. Then you would potentially have any transfers from board designations, appropriations, or non-operations that are impacting that operation measure. Well, you just need to make sure that you're disclosing the detail behind those transfers. So you don't just say transfer into operations. You say it's transfer of gifted equipment, it's a transfer of investments, it's a transfer of equipment acquired with donor funds. It's really just providing that level of detail.
Yeah, it seems like, Matt, I don't know about your clients, but it seems like a lot of my clients have just been really sort of pushing back and expressing their frustration with this presentation. And you can even see it come through in some of the comment letters that there's a lot of disagreement with the proposed transfer presentation because it's cumbersome, it's confusing. Nonprofit organization financials, like you just mentioned, are already very different from for-profit entities. So if you have board members that, have historically been used to seeing for-profit financials, then they're getting used to seeing nonprofit reporting. And then now this is thrown in where it's not really telling their story. It's just, it's just creating more confusion and more clunkiness to the financials.
I think that's what, just sitting back and listening to all this. Yes, transparency is very apparent, but the other word that I would think of when kind of sitting in here and listening in all of this, Stacy and Matt, is more. Mm-hmm. It just feels like more.
Mm-hmm.
Yeah, absolutely, Dean. So again, this would be, as part of phase 1, effective for those of you that are already presenting your financials with a measure of operations. The next handful of slides are kind of at least giving you an idea of what that phase 2 piece would look like if that ever gets passed down the road. So what that is for your statement of activities, the exposure draft provided potentially you could either use a one-statement approach or a two-statement approach. There's probably pros and cons to each. If we move to the next slide, we'll see our one-statement approach. Here you just see there's a lot of information on this page, right?
More. I see more.
Yeah. So the benefit, I guess, of a one-statement approach is, okay, yeah, we get all the information's in one place. We can see everything. You have your revenues, your releases, your expenses, your operating measure, and then all your transfers, your non-ops, all that stuff, both by without donor restrictions and with donor restrictions. So it's all in one place, but again, it looks like more, and it's a little bit messy. The other approach is your two-statement approach, which is on the next slide. And this kind of breaks out your statements from the without donor restrictions piece and then the with donor restrictions piece. So instead of having the two-column approach, this is the one-column approach. So you have your operating revenues without donor restrictions, your operating expenses, your operating excess before transfers or transfers. Then the second part of the two-statement approach would go into some of your non-operation piece, that doesn't have a donor restriction, and then it has your donor restriction piece, and those added together, is your ultimate change in net assets. So this one's seems a little more cleaner, but it's also multiple pages.
Yeah, it seems like it's multiple pages, but it kind of also highlights how your organization is doing. From a P&L perspective for the for-profit board member, they can kind of really see, well, this is how my operations is doing. This is how the business line of donor restrictions is doing with regards to investment returns and expenses and kind of all of that. So that seems like, even though it's easy to digest.
Yeah, I think, to that point that Matt and Dean, you guys both mentioned, in the for-profit world, they're probably always used to seeing some type of MD&A or management's discussion and analysis in the financials too. And I remember at one point early on, the nonprofit advisory committee was discussing whether or not something like that would be included in the exposure draft for comment and further discussion. I know that there's still, a lot of constituents and users out there that feel that this type of information would be better served in that type of presentation in the financials. So maybe that's something that's going to be redeliberated a little bit further as far as the phase 2 objective.
Right.
And that brings us to our last polling question for today. So last polling question, again, make sure if you're here for C that you answer. Would you prefer that an intermediate measure of operations be required? A, yes, B, no, or C, you're not sure. No right answer, just kind of want to get a pulse from the audience. And for those of you who are wondering what's the timeline for the implementation of these changes, we're actually going to get to that right after this polling question. So just want to make sure that you understand we'll get there shortly. So again, would you prefer that an intermediate measure of operations be required? A, yes, B, no, C, not sure. We'll close the polls here in 3, 2, and 1. Looks like about more than half said they wouldn't like it or wouldn't prefer it.
Yeah, so it seems like nobody's jumping at the bit to implement this as soon as possible as the measure of operations. So I think that's why it's deferred to phase 2. I think many of the comment letters have expressed the same thing. And when we were talking about it earlier, it's not just more information, but more work from your perspective as to figure this out and figure out how to track it internally.
Dean, you had a good analogy for it before, something about UPMIFA.
Yeah, I said, gosh, this really feels like UPMIFA on steroids. It just feels like a lot of tracking on the client's behalf. Feels like you don't need to change your chart of accounts or anything like that. I think you do need to look at how the organization should look at how you would currently get the information you need to comply to this type of reporting. Because as you can see here, we do have an effective date looming, and you want to make sure that you can get the information necessary to comply with these reporting standards.
Yeah, so Dean just alluded to effective date. Assuming this gets finalized this year, the board has settled on an effective date for financial statements for fiscal years beginning after December 15th, 2017. So what that means for, most nonprofits, if their fiscal year ended June 30th, that means June 30th of 2019. If you're a calendar year end, that's December 31st of 2018. So, there's definitely a lot of runway and a lot of time to get caught up on this, figure out how it really impacts your organization. But, it's something that's expected to be finalized this year, and, it's something to start thinking about because, a handful of years from now, that'll be here before we know it. I did want to mention early adoption is permitted. So if you're ready to get going on this as soon as it gets finalized, feel free.
And send us your financial statements. We'd love to see those as well.
Yeah.
But it's subject to the transition method guidance. So I think as we mentioned earlier, the transition method is a retrospective application. So for all years presented, you will retrospectively apply that. But you have the option to omit the analysis of expenses by both function and natural classification. So, for the year where it's not effective, you don't have to disclose that piece, as well as any disclosures about liquidity and availability of resources.
Yeah, and I think, there was a question that came in earlier in the presentation about the effect of all of this on the 990. And just, any talk about proposed 990 overhaul or changes. Matt, I don't know what you've heard on your end, but I mean, right now, I don't think that there's been, any coordination or effort or any hint of what the changes to the 990 might look like. I mean, I anticipate that just like, when MIFA came out, that's going to happen. We just sort of, don't know any specifics or timeline yet there.
Okay. So, based on the fact that this feels like more, before we kind of jump into questions, one of the things that a question that I have is, this feels like more work, and could this affect the cost of audit fees? I mean, it just feels like there's a lot more work to do here.
Yeah, I would agree. I mean, I think that, like Matt said, we still have some time. Even if phase 1 becomes a final standard this year, we still have some time for implementation. But I think that it's beneficial for both auditee organizations and auditors alike to start talking as much as possible about how these changes will impact each individual organization. Figure out how that runs into costs. I know for us, we like to approach, client service in a collaborative manner and no surprises. So that's definitely something that we're going to be doing with our clients proactively.
And I think also that, when you talk about what is the individual impact to each organization, Stacy, I think that everybody should almost say, well, if this happens, what is the new story that my financial statements could be saying based on this change, right? Does this change, whether maybe I'm an organization that's very reliant on my endowment, and my operations don't fund much of my my program. My operating revenue doesn't fund most of my program. I fund most of my program through fundraising activities or through my endowment. That's all it seems like that's all gonna get pretty transparent here.
Yeah, absolutely. And nonprofits, to Dean's point, I mean, nonprofits should just be prepared to address any changes in perceived, perceived comments or perceived perception about the financials in the new presentation.
Okay. So in conclusion, and we'll jump into questions next, but in conclusion, today we've identified several proposed FASB nonprofit financial statement changes. We've described how the new rules might affect different types of nonprofits, and we've listed ways to effectively present the revised financials to your key stakeholders.
Okay. So there was a question about multiple elements, grant components, and whether or not, if you had multiple elements to a grant, if you were going to be required to break that out in the presentation. I believe this came in when we were talking about the presentation of net assets with and without donor restrictions. And I would just say there that the grant, which has multiple elements, irregardless of its training or service delivery or other components, that it still should be looked at for those restricted purposes. Because like we mentioned, that's still sort of the driver. It's the driver internally, and it's also the driver for the financial statement preparation. And so you need to look at the restriction for presentation, but also need to look a little bit further about programmatic activities within that grant. Because remember, that will be required to be disclosed in more detail in the notes to the financial statements, including when those restrictions or resources would be available. Matt, do you have any other comments on that? Hopefully that addressed that question.
No, yeah, I think that makes sense.
I did see a question on when would, with regards to the liquidity section, when would that take effect?
Yeah, so the liquidity section would be part of phase one, and that's the phase that we're anticipating a final standard on sometime in 2016. As Matt alluded to, in the effective date, if you're a calendar year end, you'd first have to implement that 12/31/18. If you're a June 30 year end, you'd have to first implement June 30, 2019. I got to make sure I got all those dates right. Matt, is that correct?
You got it.
I got it. All right. There was another question that came in about just sort of how the disclosures about cost allocations would potentially solve the overhead myth. Thoughts on that?
Yeah, I'm definitely not going to answer that question, but I definitely think that's good to hear that kind of thinking, because right now, there is a buzz in nonprofit about the more program, the better, and the more that we can show that we're running a very lean G&A organization and a very lean fundraising organization, the better, and everything goes to program. Well, I think people are kind of rethinking that and saying, gosh, well, what's the best for our organization to be sustainable? So with regards to that, Matt, when you're thinking about allocating expenses, is there going to be any kind of guidance with regards to, overhead and G&A and kind of stuff like that?
Like I mentioned earlier, I think the board is intending to provide some guidance as far as what those expenses and which expenses you should be considering allocating amongst your different functions. Because right now, I think the guidance for G&A and fundraising is basically anything that's not program. And there might be some examples in there, but what the FASB is going to try to do is put a lot more examples in the guidance as to what costs you should be considering allocating and how to do so.
So there was one more question that we wanted to address. It was about capital asset purchases with respect to donor restrictions. So basically, if the nonprofit organizations has restrictions that are for the purchase of equipment or other capital expenditures, that would be part of what we discussed surrounding showing those as the releases when those restrictions have been satisfied.
Well, I think, Stacy, the question more relates to that, you would release any of those restrictions when the asset is placed into service. I guess there's an alternative where some organizations are releasing those restrictions over time, like a depreciation kind of. So this in the standard, it would eliminate that alternative. I personally haven't seen that where organizations releasing that restriction over time after it's placed into service. It's usually once it's placed into service, but this would eliminate that so that all organizations are doing the same thing.
That's good to hear.
Perfect. Thanks, guys. So we're timed out. I think we answered all the questions, but we'll make sure that we go through and address any that have gone missed. Stacy and Matt are here for any other questions you might have. Their contact information is up there on the screen. Phone numbers, emails, feel free to reach out to them directly. If you're here for CE, you'll be receiving an email within 3 business days with your certificate of completion. And then again, I'll be sending out the slides and recording tomorrow. So thank you again for joining us. We hope to see you at a future Armina webinar. Have a great rest of your day.